Welcome to this 7th edition of our Investment Insight series, Magellan Minutes. My name is Mark Jordan, Head of Retail at Magellan, and today I'm joined by Ofer Karliner, Portfolio Manager in our infrastructure team. Welcome, Ofer.
Hi, Mark.
Today we're going to look into the airport sector, now that we're well and truly post-pandemic, how that's played out, the opportunities and future growth in that sector. We're now 3 years post the depth of the pandemic. How has the recovery played out, and have there been any unexpected deviations from this recovery?
Yeah, I think overall the recovery's probably gone a bit better than we expected. If you look at the key structural themes, have been as expected. So we talked about during the depth of the crisis that leisure will come back before business, domestic over international, short haul over long haul, and low cost carriers over legacy carriers. That's really what we're seeing play out. So, leisure travel is largely recovered. Business travel, depending who you talk to, but broadly speaking, about 70% recovered. So, those marginal trips aren't happening anymore. People are doing video conferencing, for example. European companies in particular are more focused on climate change, the impact of air travel. So we've seen some of those trips sort of not come back, again, as expected. Domestic has recovered much faster. I think that July IATA numbers had domestic travel globally about 8.3% above 2019 levels, where international was 11.3% behind. Again, short hauls come back over long haul for various reasons, including cost. And finally, the legacy carriers have not ramped up capacity as quickly, traffic hasn't recovered as quickly, and we can see that in the numbers. So for the June quarter, for example, Ryanair had traffic 15% above 2019 levels, where IAG Group, so BA, Iberia, etc., was about 5% behind. And really Ryanair's accelerated from there. I think their August numbers were 25% ahead of 2019 levels. So they've really ramped up capacity, as we've seen. Probably the key deviation has been around the recovery in Asia. I think it's been slower than expected. So again, the IATA numbers have July international travel out of Asia about 26% behind 2019 levels. That's really been driven by China, to a lesser extent Russia, and Korea and Japan. Now, there's a couple of really idiosyncratic factors there. All those countries were late to reopen, first of all, so they're taking long to recover. But Chinese domestic demand has replaced some of the international demand. So Chinese domestic travel is up 22.5% in July, so well ahead of what it was prior to COVID. And that's probably eating into international travel. Part of that reflects group travel hasn't come back the same way. It's a big component of overall Chinese travel demand. And we had a number of markets shut or closed off to group travel until very recently. That'll take time to re-establish itself, but it will over time. So a couple of things really impacting demand for international travel. And probably at the margin, we're seeing air routes to Europe being affected as well. So a lot of bilateral air rights are being utilised prior to COVID. Because of the Ukraine issue, Russian airspace closed European carriers. Some of the European governments are pushing back on re-establishing the air rights to China because the Chinese airlines have a competitive advantage because it's a shorter flight, less fuel, so they're trying to protect their local airlines. It's impacting demand, but probably impacting at the margin a bit.
We're hearing a lot about lower airline capacity impacting pricing. What impact does that have on the airports?
Yeah, it depends which airport you're at. Obviously, leisure ones are less impacted. We're seeing capacity spill into those particularly because there's such strong leisure demand. But if you're long haul or business focused airports, then you're being more impacted. Let's step back first of all and talk about why we're seeing the capacity constraints. So the airlines retired a number of planes during COVID. Large parts of the fleet were put into storage, or the intention of never bringing them back in many cases. As demands come roaring back, they've tried to pull these aircraft out of storage, get them recertified, get them safety checked. That takes time. There simply isn't the capacity to do all of that. I think one airline executive put to me that every airport hangar in the world does maintenance is full, and there's a big backlog. So to give you an example, Lufthansa announced at the end of June last year they were bringing back their A380s that they retired during COVID. They got their first one back in June this year, back in service. So it'll take time to re-establish that capacity. The aircraft manufacturers slowed production during COVID. as they've come out of it, they try to re-accelerate production, but there are supply chain issues affecting that. They've got hundreds, if not thousands, of secondary suppliers all feeding into the production of an aircraft. It takes time to get that re-established and build up the fleets. And finally, there's probably a shorter-term factor. There's the issue with the Pratt & Whitney engines that are affecting the A380neos. So we're seeing some of those out of service where they're getting inspected more regularly. If they do have a problem with them, then they have to be taken out of service. Again, supply chain constraints mean there's not enough spare parts to fix them all. That's probably impacting demand at the margin. I think all told, probably 26, 27 before we're back to normal capacity levels. So it's a report by a company called Oliver Wyman Consultancy. They estimated pre-COVID, they're estimating at the end of start of 2024, there'd be 32,000 planes in the sky working. The current estimate is for 28,000. It's like 12.5% reduction in available capacity. So, a big impact to overall demand. What does it mean? Well, for low-cost carrier-driven airports, so for us that's ANA, our biggest airport position. ANA, which is owned by Vinci, again another company in the portfolio, they're less impacted. We're seeing leisure demand very strong, and so the low-cost carriers in particular are putting demand in those markets. But ticket prices are up everywhere. But if you're a low-cost carrier and you're flying from Luton to Malaga in the UK or from Germany to Spain, the ticket price going from £20 to £30 isn't that impactful. If you're a long-haul airport or a business airport, the guy who's spending $2,000 on tickets now $3,000, and you're taking a family of four, all of a sudden that's meaningful. We're seeing that really impact demand for those longer-haul destinations.
And I suppose following on from that, with all these issues that the sector has to deal with, the additional one around recessionary risk in Europe, how do you overlay that when you're thinking about investing in this sector?
Yeah, so recessions are bad for airports. So travel by its nature is discretionary. You don't have to travel. So to the extent people are worried about their jobs, don't have jobs, they tend to pull back on discretionary spending. Now, at the moment, with the reports coming out of Europe, there's a bunch of surveys suggesting the one area of discretionary spending that's not being cut is travel. Will that survive a deep recession? Probably not. We'll see some pullback probably. But you also have to think about the starting point of where we are now. Now, first of all, looking at our portfolio, we can manage that in two ways. We can manage that through position sizing and through the stocks we invest in. In terms of position sizing, we're about 9% in airports, pure play airports. Probably get another 3 to 4% underlying exposure through companies like Vinci and Ferrovial who own airports as well. And we're conscious of this recession risk in Europe. They look reasonably good value to us, the airports as a whole, but we're just conscious that if the economic conditions worsen, they'll react to that at a share price level. In terms of the airports we invest in though, ANA is our biggest position. We had a big position in Vinci, which owns ANA airports. They're low-cost carrier airports. So what happens, people pull back in their spending initially, and then they go, well, actually, I still want to go on holiday. What will I do? Well, I won't take that long-haul flight somewhere to a remote island. I'll go somewhere cheap, local, Spain, Portugal. So by low-cost carriers, again, cheaper. We saw this in 2009 in Spain. So saw international travel drop 10% in 2009 during a really deep recession, GFC-driven recession. By 2010, it was back at 2008 levels. People want to travel. They simply substitute a cheaper destination, trade down their holiday to a cheaper destination. Where we are now, we think that'll probably be more muted as well. In a recession, the impact will be more muted. Again, demand's far outstripping supply. Prior to COVID, we're growing at 4 to 5% per annum underlying traffic demand globally. Even if we adjust for structural changes in the market, including business travel, really conservative, we're 10% behind where we should be in traffic terms. If we get a recession, ticket prices will probably come off. Will there be a reaction initially? Probably there will be one, but I doubt it will be as big as what we saw during the GFC.
Thanks, Ofer.
Thanks, Mark.
And thank you for joining us. If you have any questions, please don't hesitate to contact one of the Magellan distribution team members. And please feel free to share this video with clients and colleagues.